Well, the cynic in me feels probably the same way as the cynic in you, which is once they're saying retail investors come on in, it probably means somebody has a plan to siphon off the assets of retail investors. So I can't help my inner cynic from jumping out. But yeah, the interesting thing is private equity is woven into the very fabric of our economy. And I was really shocked when I looked at it. For one interesting statistic, some 30% of giant Blackstone's money actually comes from public pension plans. So the idea that it's them versus us isn't really true, in the sense that a lot of public pension plans have increasingly looked to private equity to bail them out from decades of low returns and very high level and benefits they have to pay. And so private equity is us to a large degree. If the industry falters, that's not good news for all those public pension plans that are depending on it.
That's so true. It's a point that's not made enough. And I think about it a lot of times when you have, especially people on the Democratic campaign trails who really go after private equity as an industry, say it needs higher taxes, they need to change carried interest and so forth. But again, that would undermine the pension plans that a lot of their supporters, union members and otherwise, need to do well in order to have sort of viable retirement. So anyway, they are now woven together.
I'd push back on that a tiny bit in that I don't think changing carried interest would do anything to affect the performance. And I think that if we are going to accept that private equity is woven into the fabric of our economy, there are things we could do to make it function better for everybody. But yes, the overall point is taken.
What about some of the other wins that you see here? One of the things that often happens in market downturns is the ability for these industries, whether it's private equity or other forms, to come in on the cheap, which, again, is the idea. They're supposed to come in when everybody else is panicking. But a lot of times they can add a lot of debt to these companies. That's been the big kind of, knock on the industry for quite some time. And what other ways do you think that they're winning from the coronavirus?
Right. Well, I cited a statistic in the story I did for Vanity Fair on this from a guy named Dan Rasmussen, who said that on average, private equity firms double the amount of debt on a company's balance sheet. And so you think of corporate weakness that has led to some bankruptcies in the pandemic, like J. Crew and Neiman Marcus. It's arguable if those bankruptcies would have had to happen if it weren't for private equity. So the irony, right, is that this institution called private equity that we're looking to bail pension funds out with great returns is also in some ways one that is costing Americans their jobs. So there's obviously a great irony at the heart of this. But coming out of the financial crisis, private equity firms, Blackstone in particular, made a great deal of money by scooping up real estate when it was cheap. And now you have talk of commercial real estate, of mammoth defaults cascading through commercial real estate. And I can pretty much guarantee who it's going to be that picks up the pieces from that. And on the one hand, yes, great, there's capital, right? We're going to need capital. But on the other hand, it's going to intensify private equity's stranglehold. Stranglehold is the wrong way to put it. Okay, that's extreme. It's going to intensify private equity's intrusion in our economy.